welcome to brainfood bytes. My name is Julien Gervreau, and I'm the ESG and Sustainability Services Director at Sensiba LLP. The U.S. Securities and Exchange Commission issued a ruling on March 6, 2024, that will require publicly traded companies to disclose certain climate-related information in their registration statements and annual reports. This includes, among other things, material climate-related risks, climate risk mitigation or adaptation activities, including the role that the company leadership and the board plays in managing and providing oversight of these risks, information on climate-related goals or targets that are material to the company's business operations or financial condition, and the disclosure of Scope 1 and or Scope 2 greenhouse gas emissions. These are focusing on the emission sources that the company itself directly controls. The SEC adopted these new rules in response to overwhelming investor demand for standardized information on climate-related risk and the implications that it has on companies' strategy, results, and financial condition. The ruling creates a better alignment between climate reporting and the SEC filings for a company, which paves the way for information that is consistent and comparable across entities. In fact, 90% of the companies in the Russell 1000 stock index currently provide climate-related disclosure, predominantly in the form of annual sustainability reports. So the functional impact of this ruling is really to standardize climate reporting that is already happening for most companies. This has been a hotly debated topic since the SEC issued its initial proposal 2 years ago. And that proposal initially included Scope 3, or a company's indirect or supply chain emissions. In its final March 2024 ruling, though, the SEC omitted the requirement to disclose Scope 3 emissions, citing public comments to the initial proposal that collecting the required data would be challenging and cumbersome. The ruling has since been challenged by a number of red state attorneys general, as well as some energy companies, who argue that the SEC has gone outside its delegated mission to protect investors. It is unclear at this point where the pending lawsuits will land. That said, the laws that were enacted in California back in October 2023, known as the California Climate Data Accountability Act, do require disclosure of Scope 1, 2, and 3 emissions for any company, whether they're public or private, that operates in the state and generates more than $1 billion in annual revenue. This is also consistent with the requirements issued in June 2023 by the International Sustainability Standards Board, or ISSB, for companies reporting under IFRS to disclose the impacts of industry-specific sustainability issues, as well as climate-related risks, and Scope 1, 2, and 3 greenhouse gas emissions. So companies looking to comply with the California and ISSB standards should be prepared to measure and disclose Scope 3 supply chain emissions in addition to Scopes 1 and 2. The SEC and California rulings will also likely impact many privately held and small to medium-sized businesses, even though they are not directly affected by the rulings. And this is because there's growing pressure on private companies to measure and disclose their greenhouse gas emissions. Key stakeholders, ranging from publicly traded customers who do have to report their Scope 3 emissions under the California law, to employees who want to work for climate-conscious companies, are driving behavior change for private companies across the economy. And beyond the regulatory and stakeholder considerations, more privately held companies are recognizing that an examination of Scope 3 emissions as part of a comprehensive review of their supply chain can actually lead to improvements that reduce costs, mitigate operational and reputational risks, and position themselves to be a supplier of choice to their publicly traded companies. The rules include a phased-in compliance period for all registrants, with the dates dependent on the registrant's filer status and the disclosure content. General timeline is as follows. Large accelerated filers will begin financial disclosures and annual reports for the year ending December 31, 2025. Accelerated filers will begin financial disclosures after December 31, 2026, and non-accelerated filers, smaller reporting companies, and emerging growth companies will begin financial disclosures after December 31, 2027. GHG emissions disclosures for Scopes 1 and 2 will begin in 2026 for large accelerated filers and 2028 for accelerated filers, and will not be required for non-accelerated filers, smaller reporting companies, or emerging growth companies. GHG assurance will begin to be required beginning in 2029 in a limited capacity, stepping up to reasonable assurance by 2033. AICPA has been tracking this issue closely and recently published an article in the Journal of Accountancy that summarizes the 886-page SEC rule. We at Sensiba have also been closely monitoring these developments and have a team of climate and sustainability professionals available to discuss the implications of the SEC and the California rules for companies of any size. We recommend that companies who are just beginning their climate journeys start by conducting a baseline greenhouse gas emissions inventory to better understand their impacts across scopes 1 through 3, and then use that information to identify cost-saving opportunities that they can then leverage to reduce emissions. For additional information, please visit the Sensiba webpage at sensiba.com/solutions/sustainability.